Hello everyone, this is Professor Kent. Today's recording is review for chapter 15, 16, and 17, volume 2. And the first question we're going to work on is I believe this is from chapter 15, when you repurchase your own shares and there's a price difference when you repurchase. One, you buy it more than what the book value is. One, you do it under less than the book value. So the first two questions, well, one will be more than the book value. The other one is less than the book value. So let's see how we could do this journal entry, or how we're going to solve this question. It's, in this case, Higgins has 52,000 common shares outstanding with an average cost of 21,000. If they don't give you an average price, you have to calculate the average price. How do you calculate the average price? Is the dollar value of your shares divided by the number of shares, and that will give you a book value, or we could call it an average price per share. So that'll give you book value or an average price. In this case, they told you what the average price is in our books. And what we did, if we didn't reacquire all the shares, required to repurchase. One, we reacquired only 800 of the shares. So when that happens, we have to debit common shares. How many we are reacquiring? 800. What was the book value, which is your average value? 20 average cost, which is 21, gives you 16,800. Going further, how much cash did we pay? They said that we require shares at $56, so that's what we paid in cash. So 56 times the 800 gives me 44,800. So now what we have is, we have the book value, that or the average cost. Book value or an average cost that are sitting in our books is 21, and the price that we paid, $56. So difference between those two will be going into my retained earnings, and that will be your 28,000. And at this point, we don't know if they had any contributor surplus, because they said that there's no contributor surplus. If there was a contributor surplus, then you clear your contributor surplus, and then the leftover will go to my retained earning. So let's see, what do we have in next one? I see we do have a contributor surplus, so your entry will be different, but not, it'll be different. So let's see what the question is asking. We have to again prepare the journal entry. Spencer Limited has 50,000 common shares, and an average price of the share is $8 per share. On August 31st, they reacquired and canceled. So when you reacquire and cancel, that means you have to take it out of the circulation, the common shares. So that will be 60 times your 600 shares times your $8 per share. That is your $4,800. Then what we did is we paid cash. We paid 600 times the $40. That's how much we paid. So the price that we paid was 24,000. Going further, they said there was a contributor surplus of 0.25 per share. So at the time of reacquisition, which was 12,500. How did they calculate it? We had 50,000 shares, and multiply by the 25 cents gives you 12,500. That's in my contributor surplus. So now if you look at the difference between the both, is $32 per share times the 600. So that will give you what is the, I didn't have a number. 32 times the 600 gives you 19,200. So that's the difference. First we clear your contributor surplus, then the leftover will go to my retained earning. So I'm going to clear my contributor surplus, and that is your 12,500. We cleared everything, and leftover will go to your retained earnings. So that will be the $6,700. So what we did is we purchased at more, we purchased more than the book value. So then first you clear your contributor surplus, then the leftover go to retained earning. If it was a less, then it goes to your contributor surplus. Going further, now this was a multiple choice question. I converted it into a normal question. So in this, what are they asking you to do is they are asking you to, this is chapter 15. So we are distributing the dividend. So it's a chapter 15. Riga has an outstanding 100,000 common shares and 20,000 no par value 40 40 cents preferred share issued at $5 each. So and then they said that we have both, we have preferred shares, we have a common shares. The number of shares we have is 20,000 common shares. The dividend rate is 0.40, and the value of my preferred share will be 100,000. How did I get that 100,000? They told us in the question they were issued at $5. So 20,000 times the 5 will give me 10,000. And what is 40 cents? 47 cents is a dividend that we're paying them. They said the preferred shares are cumulative and non-participating. So the preferred shares are cumulative and non-participating. So we are going to look at a cumulative participating. Going further than what they said, that dividends are paid except for the past 2 years. So we haven't paid any dividend for the past 2 years. So the value of your common share, the value of your common share is 200,000. We do need that because they're they're non-participating. But let's look at what they're saying it. The common share, okay, assuming that 61,000 was distributed as a dividend for the current year. So we have preferred share, we have a common, and then the total dividend that we're paying them. That first one is we're paying them 60. So they're cumulative. If they're cumulative, we needed to pay them the arrears. The arrears will be, I have 20,000 shares. In my preferred, we have 20,000 shares, and then we're going to give them 40 cents per share, and then we haven't paid them for 2 years, so we're going to give them 16,000. So we gave them 16,000. So then we are left with, my calculator is somewhere, 61,000 minus your 16,000 gives me 45,000. So that's what we gave already. Then we have to pay the current year dividend to my preferred. So $20,000 times your 4.47, I paid them 8,000. Now we needed to know, and the preferred shares are also fully participating. So we're doing a calculation when the preferred shares are cumulative and fully participating at this point. So at this point they said we need to do the calculation when the preferred shares are fully participating, and we want to know how much should give it to common. And it doesn't matter how much we give it to the common, we need to do the calculation. So we want to know what percent did they get. So we take the 8,000 divided by the value of your preferred shares, that is $10,000, 100,000. That will give me 8%. And we are going to give 8% according to their ownership in the company. And who is that? Common shareholders. So that is your 16,000, and we paid them 24,000. Then the leftover we have to is a participating. So whatever is leftover, which is 21,000. So there's a different way of doing it. We have 100,000, and we already have 100,000 in my preferred, 200,000 in my common. So altogether the total value of your preferred and common is 300. You're going to take your 100,000 divided by your 300,000, multiply by the 21,000 here you have 200,000 divided by 300,000 times the 2100, and that will give me 16,000, and the other one will give me 5. Oh no, I did it wrong. I think it's the other way around. So 100 divided by 300 times the 21 gives me 100,000 times, sorry, 7,000. I get a 7,000. Here I will get 14,000. I'm just checking my numbers that if they are correct, times your 21,000 gives me 14,000. So I'm gonna give them the 7,000. I'm gonna give them the 14,000. If I add them together, I will get 21,000, and I given them everything. So this will be your participating dividend, participating dividend. Now the question can say that like if this is we paid them 8%, the question say that we pay them 10%, and then the leftover will go to the common. Then if that happens, then you have to give them the 2%, and whatever the 2% according to their ownership, and the rest will go to there. So depending on the question, if the preferred shares are how much total we should give it to preferred share, if they can give you how much total we should give it to preferred share, they can also give you how much total we should give it to how much we should give it to the common shareholders. So going into this is a similar question that we have, and then the only difference is we're paying 54,000 dividends. So altogether we paid them 30,000. We paid them 31,000 here. Going further, we have preferred shares, we have a common shares, and we have a total, and the total we're distributing is 54,000. So that's how much we are distributing. So going further with this question, and they said that they are cumulative and fully participating. So cumulative and fully participating, we needed to worry about arrears, then we worry about my current year, and then we worry about our participating. So arrears says we haven't paid them for 1 year. How much do we owe them? We owe them 10,000 times the 0.6. 10,000 times the 0.6, and that will give me 10,000.6 will be my 10,000 times your 0.60 will give me $6,000 in arrears. My current years will also be 6,000. In this case, it's a fully participating, so I already gave them 6,000, and now I needed to know what percent did they get. So I will take the value of your preferred share, which is 100,000, divide, and we gave them 6,000, so we gave them 6%. So this is a 6% we gave them. If I gave them 6%, and I needed to give them the 6%, and that will be your 12,000, because the value of your common shareholders is your 200,000. So I just wanted to know if 6,000 divided by the 100,000 is your 6%. Yes, it is 6%. So we gave them 6%. That will be 6% times your 200,000 shares. Then that will be my 18,000. Then going to participating, whatever is the leftover, 54,000 minus the 6,000 minus the 18,000, and that is my 30,000. Now we're going to distribute according to their proration, 10,000 and 200,000. Altogether we have 300,000. That's the total equity. 100,000 divided by the 300,000 multiplied by the 30,000. Then this is my preferred, this is my common. 200,000 multiply divided by 300 multiply by the 30,000, and let's see what number we get. Times the 30 will give me 10,000. I give it to them and I will give them the 20,000. This will come up to be 10,000. Show me your work when you are doing this question so that you get full marks at the test. So that's how we did. How much did we give it to them? We gave them 32,000. We gave them what did I give them? 6 plus 6 plus 10. So we gave them all together uh, 22,000. So I gave them 22,000. They said how much would the common share will receive? Common share will receive 32,000. That's how much they will receive. Going further, now this question is from chapter 16. Under 16 we have derivatives. This question is related to derivatives. When we talk about derivatives, there's three types. We have options, we have a future contract, and we have a forward contract. So those are the three. Question can come from anywhere. Now the journal entries are similar but not same, so they're similar but not same. So it's your job to learn the options and the future contract. Now this is a forward contract. So again, we have options and we have a future and we have a forward. So we're going to do this question with forward. There's not a big difference between the both, and but you needed to learn how to do each one. So you could go at the back of the chapter or you can watch the videos and for the examples. Trudel builder uses for 2.6 lumber as a framing. Uses fair, I don't know what this means. 2.6 lumber, so this is what I think is a lumber industry. So they uses something to frame the material. So what they use is for the framing purposes they use the 2.6 that's the length, the measurement of the lumber is. On November 15, 2023, Turtle entered into a forward contract. So something is happening. When is happening? It is happening on oh, something happened. So on November 15 we got into a contract. And what type of entered into a contract? What type of contract is a forward contract? So on November 18, did we pay any down payment? No. So we're going to get this delivery in 2024. So on November 15, 2023, we just signed a contract. If you signed a contract, and what we have is we have no entry and we did not pay any deposit. So no entry at this point. November 15, no entry. Going further, then the company has a year end, and if again derivative have no value, they derive their value from other instrument. In this case it is from a forward contract and they are recorded at a fair value. Derivatives are recorded at a fair value. So we are going to go to next. What we have is we have a December 31st 2023 and we needed to close our year end. So let's see, the marker price of March for March delivery is 26. The price, the grant price, the price that we signed the contract at is 25 cents. The price on December 31st is 0.26. And then how many lumbers are we buying? So if I take the difference between the both, it is 0.01 multiplied by the 1.5 million. So that's the price difference. So the price difference, it is you could have a gain or a loss. In this case it's gone up in a price, so we will have a gain, and the gain will be for $15,000. So then we don't have anything in my derivatives. We needed to put derivatives in. So we will call it derivatives financial asset slash liability. And that will be for $15,000, and we will have a credit. My credit will be gain slash loss on derivatives. That's your $15,000. So going further, now we know that we had to post this entry. So we have a derivatives financial assets slash liabilities, and that is my debit of $15,000. So going further, what happens, what we did is we took a delivery of 15,000 boards for $25 and settled the forward contract. The marker rate on this date was 28, so the price that we're going to pay is 25 cents. So that will be the cash price that we have to pay them, because that was our contract that we're going to pay them 25 cents per lumber, and we had 15,000 lumbers at 0.25, and that will give me 375,000. Then going to I needed to make this derivative account to be 0. I will do a debit to my derivatives financial assets slash liability, and that will be sorry, no, that we needed to credit it, so it was sitting as a debit. So I will credit it derivatives for $15,000. So we record this lumber as an inventory in our books. We will record it at the fair value. The fair value of the lumber is 0.28 cents multiplied by the 1.5 million lumber, 1,500,000 lumbers that we bought. So that will be $420,000. So what we have is we have a gain slash loss on derivatives, and that will be $30,000. So that will be your $30,000. So did our entry balance? Yes, our entry did balance. So the entry does balance. So this is how we will do the forward contract. Again, learn about the future contract. The entries are same but not, they're similar but not same. Then we also learned about options. So that those are the other two things we learned in the first part of your chapter 16. So going further, we have, this is my contributor surplus. We have when you have a conversion, when you convert, what happens? They're saying Connor Corporation sells 100,000 5-year 8% convertible bond, and payable interest is payable annually for 106,000. The marker rate is 10%. So what we have is we have a present value of our bond, and we have a future value of our bond. And then what they told you us, they said that we issued this convertible for 106. So the cash is 106, but we needed to calculate the present value of our bond. So we can do is we can distribute how much should go to my contributor surplus conversion, right? So the face value of your bond is $100,000. My payment is my coupon rate, my 100,000 times your 8%. It is annually, and that will give me 8,000. So that will be my 8,000. That will be my payment. My present value I have to compute. My N is 5 years, and we are going to compute my present value, and that present value will be 92418. When you have when you have a when you're using a residual value method, it doesn't matter if it's an IFRS or ASPE. If they're using a residual value method, that means you first measure the value of your bond, and the leftover will go to your contributor surplus conversion rights. So we are going to have a bond payable, and in this case the bond payable, the present value of the bond is 92,418. The face value of your bond is 100,000. Difference between those two is my discount that I needed to amortize. That's what we needed to do, and amortize. So if it's IFRS, we'll use a straight line. If it's if it's a IFRS, we'll use an effective method to amortize this discount, and if it is ASPE, will use a straight line. And sometimes in the question we might not need to work it out the straight line or effective method, depending on the question, because B is telling us what to do. So that will be my first entry, 418, and then we're going to have a contributor surplus conversion rights, and that will be the difference between the both will be 135.82. How did I get that? We paid 106. We allocated part to my bond payable, and then the leftover will go to my contributor surplus conversion rights. So what they did is they told us in the question, assume all the now we're going to go to the next part, is my part B. And what is part B? Assume that all of the Connor Corporation, all, so sometimes we convert 100%, sometimes we convert 25, 50, whatever the question tells you, converted into 1,000 common shares. How did they get the 1,000? I had a bond for 100,000, and each bond can be converted into 100 common shares. So divided by 1,000, multiply by 100. So if I were to do that, so this is how we got the each 10,000 bonds, so that's how we got the 1,000. So that's how we got the 1,000 common shares. But that's what not the question is asking. First we needed to know what the carrying value of our bond is. So the carrying value of our bond will be, in this case they told us that we have a calculation shows that 4,974 of the discount has not been amortized. If it hasn't been amortized, we're working backwards. We are going to work with the face value of our bond as 100,000, and what we do is what hasn't been amortized, we needed to minus it, and what that will give me the carrying value of my bond. So I will debit my bond payable. If we paid extra, then you will have to debit the loss on the redemption of the bond. So that will be 95,206. And then what we have is we have to get rid of the contributed surplus conversion rights. And that is your 13,582. And then we have a common shares. How do we get the common share? You have a value of your bond payable plus your contributor surplus conversion rights, and then if I add both numbers, 108,608. So that's how I get the number. Going further, now how many shares were converted? We converted 1,000 common shares. So this bond is converted into shares. When we converted into shares, we issued new 1,000 shares. So we issued new 1,000 shares. So now this question is related to the weighted average shares outstanding, and they said that these are some of the things are happening within the company. And what we have is we have preferred shares, and we issued 3,000. They have 3,000 shares. The price for the dividend per share is $2. So we needed to know how first how to calculate my earning per share before we can calculate my earning per share. I needed to calculate my weighted average shares outstanding. So let's see if we could work out the question and see what the question is going to be. So let's do that. So we have a, I always start with the date, and then we have number of shares, and we have a fraction of year, and then we have weighted shares outstanding. So the date we started off with is January 1st, and that will be my beginning balance. And I started off with beginning balance, we started off with 150,000, multiply equal to, my next date is my April 1st, and how many months are gone by? January, February, and March, and we have how many months are gone by. So let's look at it. I have to get my calculator, and we have 3 months are gone by, so we are going to do 3 over 12. And what did we do on April 1st? We issued 2-for-1 split, a 2-for-1. So now 2-for-1 means is 2 over 1. So we issued how many more shares? We issued 150,000 more shares. So we issued how many more shares? 150 more shares. How did I get 2-for-1? So now we have 300,000 shares outstanding, or you could do it 150,000 gives you 300,000 shares. So that's what you could do, or you could say that we issued 150,000 new shares. So that's what we are going to do. So now multiply, before we get it, we had, what did we do? 2-for-1 split. So whatever we needed to restate everything that was there before, so that's 2 over 1, and we needed to go further what's happening. Then my next date is my July, and what we did is we issued, if you issue it, we add it, and that will be how many we issued? 20,000 shares. That is your 320,000. We want to know how long they were outstanding. April, May, and June, they were outstanding 3 over 12, and we needed to work out the number at that point. So let's go to my October 1st. What happened on October 1st? We repurchased. If you repurchase it, you have to minus it, how much we repurchased. In this case, it was 50,000. You were left with 270,000. How long this one was outstanding? July, August, September. So this is 3 over 12. Then we needed to go to my December 31st. Again, if they were issued on the last date, we don't need to include it into my weighted average shares outstanding. So we have October, November, and December, 3 months. So 3 plus 3, 6 plus 3, 9 plus 3 is 12. So we needed to make sure that you calculate you're not more than the 12 months. So in this is my weighted average shares outstanding. I needed to work out the numbers. I don't have the numbers. So we have 150,000 multiplied by the 3 divided by 12 times the 2. I will get 75,000. My next one is 300,000 times 3 divided by 12 will also give me 75,000. 320,000 times your 3 divided by 12 will give me 80,000. Then 270,000 multiplied by 3 over the 12 will give me 67,500. And I add all the numbers. And I will get the answer 297,500. Going further, then what we needed to do is we needed to calculate the earning per share. So my earning per share formula is net income minus your preferred dividend divided by weighted shares outstanding. So we just calculated the weighted shares outstanding, 297,500. My net income, they told us in the question, is 476. 000 minus your preferred dividend, that is 3,000 shares times the 2, that is your 6,000, and then I will get the earning per share of 1.58. So that's what the earning per share is. Now this question is similar, but in this case we have a diluted earning per share, and we have, they told us to work, it's the same question I believe, but they asked us to calculate the weighted average shares first. But in this case we have 10% stock dividends and they repurchase. So if you were to do that, the first thing you had to do was to calculate my weighted shares outstanding. Again, I'm just going to give you the number because I already worked it out, and now the similar type of question, the number you'll get is 162,500. If you wanted me to show you this, you send me an email or write underneath the video. I can show you how we got the answer. Now the part here is we needed to calculate the basic earning per share. Everything is exactly the same, so the number that I will come up with is your basic earning per share. Since your weighted shares changes, so we have so I'm just going to do it. So my net income was 476, and I have 6,000 preferred dividend divided by 162,500, and that will give me $2.84. So if they said that the dividend, in this case Darko issued $3,002 cumulative preferred share dividend for 300,000. However, dividends were not declared. So if they were not declared, we needed to deduct the current year's dividend. That's the first thing we're going to do. The second thing is this question doesn't have the bond. So the bond can be converted into shares, and then the option can be turned into shares. So first is we always needed to work out the earning per share. The second one is they're asking you to calculate a diluted earning per share. We are just going to finish, we just finished our chapter 17 in class, so this is why I brought in a simple question, because you already worked out so many questions. But options are always hard for people to know. So what we have is marker price, and we call it an exercise price. So they said the exercise price is 20 and the market price is 25. Would you buy it? So is this in money? Yes, they are in money. So if they are in money, we want to know what are the incremental shares outstanding when we are working out our diluted earning per share. So first we needed to do is the proceeds that we received by the cash proceed that the company received on exercising their rights. So the exercise, how much they were going to get, 15,000. So the price that they received was 20. The proceeds the company received was 300,000. So that's what they received, 300,000. So what the company is going to, number of shares they are going to issue, is 15,000. So what we had to do is the proceeds we received, we needed to buy our own shares. So we buy back our own shares. So the price we received, proceeds we received was 300,000 divided by the marker price. The marker price is 25, and then what happens is that will give me the $12,000. So what will that 12,000 is we're going to buy back our own share. The company will do that minus the 12. So the incremental shares will be $3,000. So incremental share will be 3,000. So incremental share will be 3,000. If I were to think about it, from the company perspective, they got $3,000. They use that to buy their own shares. At the top number we are going to have a 0. At the bottom we are going to have 3,000. 0 divided by 3 will be 0. They will option will always be ranked number 1. So then the first one is you have to calculate your basic earning per share. Your basic is 476. Your basic is 476,000 minus your preferred dividend, which is your $6,000. So this doesn't change. So this is my first one, divided by number of shares outstanding, 162,500, and that will give me 289. And then going further, and then my first rank number 1 will go in at the top. I will add a 0 at the bottom. I will add the 3,000. I will rework out my numbers with the rank number 1, and that will be at the then it'll give me an diluted earning per share will be 284. You can also have a bonds that can be converted into shares. You can also have preferred shares. So those are the two other things can have. Again, go back to the chapter we already done. I already have the videos for chapter 17, so go back to the videos, homework videos, in order to learn little bit more complicated questions. So but we have gone through a lot of questions in class, so we have done at least 10 questions. So if you weren't present in the class, you could read, you can watch the videos, and there's some homework videos for chapter 17. Thank you so much for coming and listening to me. Take care and bye for now.